Hey, so I just want to talk about why I'm bullish on Robinhood, and I'm going to try to do that by comparing it to Charles Schwab. So if we break it down, Robinhood has primarily two different ways of making revenue, and Charles Schwab has three different ways of making revenue. And let's just see what they are really quick. Okay, so if you look at the net income statement over the past 2 years for Robinhood, it shows that they have transaction-based revenues, net interest revenues, and other revenues. While Charles Schwab, on the other hand, has three, like I said. They have net interest revenue as number one, asset management and administration fees as number two, and trading revenue number three. Two of those overlap: net interest revenue, obviously, and the trading revenue, which Robinhood states as transaction based revenue. So, as you see here in Charles Schwab, it's broken down by commissions, order flow revenue, and principal transactions. Well, that's actually become negligible. So it's basically commissions and order flow revenue. But I think they actually removed commissions. I'm not sure in 2019, so I'm not sure why that's still there, unless it's like some sort of other commission. Maybe it's related to order flow revenue. I'm not really sure, but it's still order flow essentially. Order flow is a big part of that trading revenue for Charles Schwab. Well, that's pretty much entirely for Robinhood's transaction-based revenue, that order flow, which is either for stocks, options, or crypto. Net interest revenue is primarily when companies invest the cash on their users or clients' balance or accounts. They use that uninvested cash and they put it into a bank account and they get interest on that money, and they pay you in return chump change. So say you have $1,000, Charles Schwab may give you 1 penny every month for that $1,000. Also, it's through margin interest. So when someone wants to borrow money to invest, they get interest on that loan, as well as lending securities like stocks. I think when people short them. So those are three. That's what net interest revenue is. But primarily, I think it is when companies invest. At least Charles Schwab. In Charles Schwab case, they get a lot when they invest uninvested cash in people's accounts. Robinhood, since their clients, since their user base doesn't have a lot of money, they actually don't get a lot of money from investing that cash. Then other for Robinhood is the gold subscription, while Charles Schwab, they have 30% of theirs is asset management fees. So if you look here, that's mutual funds, ETFs, and collectible trust funds. So Charles Schwab has proprietary ETFs that follow the market or different parts of the market. Same thing with mutual funds, and they get percent from that just from managing that portfolio or ETF every year. They get a tiny percent of that, and also have advice solutions. Obviously, Robinhood doesn't provide any advice to their clients because people who have a lot of money typically wants financial advice. I don't think Robinhood is in that position yet, but I think they will in the future. And Robinhood clearly doesn't have any proprietary Robinhood accounts or ETFs. Maybe they might in the future, but I think it's too early for them to do that right now. And then I actually broke it down here. Since Robinhood gave us 2 years worth of data as well as the first quarter of this year, I decided to stack that up with Charles Schwab as a percent of revenue total. So if you see trading revenue for Robinhood went from 62% in 2019 to 75% in 2020 and 81% in the first quarter of this year, while Charles Schwab was at 7%, then 12%, and 21%. So they've gone up, and I think that's a function of people just trading more as the markets just go up. While net interest as a percent of revenue has gone down. Robinhood at 25% in 2019, then 19% last year, and then 12% in the first quarter. Same thing with Charles Schwab, 61% to 52% to 41%. So back to this order flow, which is obviously a bit controversial right now. And Robinhood gets all the flack for it because they're the most culturally relevant company in finance. But Charles Schwab does it too, as we just saw. And they actually make a lot more money from it than Robinhood just because of its sheer size. Order flow actually has pretty good margins. If you look back here to the net income statement, Robinhood, it's not very self-explanatory when you look at it because typically companies have revenue, then cost of goods sold, and gross margin. It's not laid down. It's not laid clearly here like that. So you got to do a little bit of work. So if you look at transaction-based revenues for 2020, 720 million, and then just go down here for brokerage and transaction. It's not like a one for one though. There's also some other kinds of expenses within this. So for example, interestingly, all of these expenses have employee compensation, which is a bit weird, but that's how it is. Um, which means that the margins are actually better if you strip those miscellaneous expenses. So if you do 720 million minus 111 million and divide by that 720 million to get the gross margin percent times 100, that's like about 84.5%, maybe 84.6%. I did some math right here on my calculator. That's pretty high. And then once you strip out those miscellaneous expenses, I guarantee you it could be closer to 90%. It's a it's a high margin business. Okay, so then if it's high margin, why is Robinhood not making money? So let's go back to the income statement. Technology and development. So that's like cloud infrastructure. That's like a true operating expense. Well, I'll consider brokerage and transaction kind of like a cost of goods. So, anyways, technology and development, one of their second largest expense, 250 million last year. Then they have operating, marketing, G&A, so it's like customer support, credit provision for credit losses, and then marketing is like the referral program, and then G&A is like money set aside for legal settlement and send professional fees. And like I said, every single one of those expenses has stock or employee compensation, which is really weird. Like I think like stock compensation, and I think it suggests that Robinhood's in the growth phase and they're paying a lot of the companies and our employees in stock, and that's what I assume, and that's how they attract new talent through Robinhood stock, and that's just adding up to their expenses. Um, okay, so if we just strip out the employee compensation part and just take these numbers for what they are, it's not too concerning. Well, actually, if you look at 2020, they were actually profitable because 2020 was one heck of a year. Unprofitable in 2019. I think they're unprofitable in the first quarter. Um, so they have to, people say like they can't replicate 2020. They do it. They're barely breaking even. But that's just assuming Robinhood stays at this size for a very long time or forever. They're going to keep growing and growing and growing and building that revenue. And then as they get more customers, that transaction-based revenue, I think, is going to go down as a percent of total revenue as they get more money from that net interest revenue, like what you saw with Charles Schwab. As they get more, as their user base gets older and they get more customers, they're going to have more money total to invest in bank account or to get net interest income or net interest revenue. And of course, there'll be more trades going on, so they get more transaction-based revenue. I don't think order flow is going to go away. If they do, then Robinhood's going to zero or something. I don't know. But these operating expenses, technology and development, operations, marketing, G&A, I think they're manageable so long as Robinhood keep growing. Like I think it's a very scalable business. That's what I'm trying to say. But then you have to come back. Okay, Robinhood is overvalued, and yeah, it is overvalued based on all the metrics that you see out there. And I'm going to go over a couple of those that I think make the most sense. So Robinhood is a $29 billion company, while Charles Schwab is a $128 billion company. So it's like 4.4x. Did some quick calculator math. But then when you look at the assets under custody, which is like a very important metric that these companies use, it's so important that Charles Schwab actually has it on there, like their first page that you go to when you go to their investor relations, and they proudly say we have 7.57 trillion dollars in assets under custody, while Robinhood has 81 billion dollars in assets under custody. So that's like whether in stocks, options, crypto. Obviously, Charles Schwab doesn't deal with crypto, but that's pretty much what it is: stocks, options, cash, whatever it is. It all adds up to 81 billion for Robinhood and 7.57 trillion for Charles Schwab. And when you're dealing with numbers that big, you really can't appreciate. And I'm going to give another big number to make it even smaller, but it's so big to comprehend how big of a difference this is. Charles Schwab has 93 times more assets under custody than Robinhood, yet it's only worth 4.4 times more than Robinhood from a market capitalization. So either Robinhood is grossly overvalued based on this, or Charles Schwab is grossly undervalued. What is it? And get this number too. So in Q2 of this year, Charles Schwab added $109 billion in assets under custody, which is more than what Robinhood has total, $81 billion. So it added a Robinhood in one quarter. That's 1.5%. It's a behemoth. And we're not even talking about Vanguard. It's not a public company, obviously, but they also have a lot of their own ETFs and cash management, whatever businesses. It's like a Charles Schwab, but not public. So those are the two measures I want to go over. But like I said, I'm bullish on Robinhood. I'm going to tell you why. I totally forgot to mention this, but Robinhood has 18 million accounts. Charles Schwab has 32 million accounts. So those 32 million on Schwab have $7.5 trillion. Well, at 18 million at Robinhood has $81 billion, or 93 times less. That's insane. That just shows you how much money the people out Schwab have. But anyway, so why am I bullish? I think it's because Robinhood, first and foremost, I think is going to steal money away from the Charles Schwabs, the Vanguards. Okay, so Robinhood has a lot of young people, 18 like 30, whatever, a lot of millennials, some Gen Z as well, a lot of Gen Z. I think the oldest of which are like 24 years old. But there's going to be a massive wealth transfer from the baby boomers to their children. And I think a lot of that money is going to go from Schwab and Vanguard to Robinhood, if and only if Robinhood can really establish themselves as a legitimate and trusted company when it comes to finance. Right now, they're a little shoddy just because of what happened with the meme mania in January. If they can get over that and really establish themselves as a legitimate company, well, they already are, but you know what I mean. I think a lot of that money is going to get transferred from Charles Schwab and Vanguard to Robinhood, thereby boosting that net interest revenue. Number two, international expansion. They even said this in their S1 filing. Robinhood has plans to expand into Asia and Europe at an undisclosed time. They don't know when, but they have plans to. Well, I looked online, like what do people overseas use? And people in Europe I saw, they tend to use Interactive Brokers and not Charles Schwab, which I thought was interesting. And I saw Charles Schwab actually close their UK account, their UK service, because of some Brexit uncertainty or something like that, laws, I don't know why, but they closed their operations in the UK. They closed their offices in Australia. I think they're still supporting Australian customers, but they closed their office over there. So what is Charles Schwab doing? Well, you see Robinhood trying to expand into these places, and I think they're going to do it. Well, Charles Schwab, I think, is just really focused on just sitting on all those assets and just getting all that net interest revenue. And they've done a really good job of doing that. So another thing, and Robinhood kind of talked about this in their S1, is vertical integration. That they have an app that it's just seamless with vertically integrating new products and markets. If you look at their S1 filing, they're called Robinhood Markets. Markets. Cryptos, options, stock markets. I don't know if we want to get into bonds, or maybe bonds too. Anyways, what's stopping them from getting into the collectibles market? Something like Road Rally or On Rally. I forgot what it's called, but it's that company that offers you to own a share of a physical collectible. So say you have a Charizard PSA 10 first edition, 1999, and obviously not too. There's like a few hundred of those, and not everyone can have one because it costs a lot of money. But there's this company, Rally Road. They they can hold one in custody and then just divide it by like say 1 million shares and offer anyone to own a share of that physical product. And then when that physical product is sold in the future, if it appreciates, the people who own shares get that cash sum. So if it appreciates 10%, you get 10% more. If it doubles, you get double what you have. What's stopping Robinhood from getting into that market? Another thing, private investing. I think Robinhood could definitely disrupt the private investing market. They're already doing IPOs. You can invest in IPOs at the IPO price. Typically, retail investors hold the bag if they buy an IPO because that IPO price jumps up like 60%, 80%, 100%, and only institutional investors can get at that IPO price. But with Robinhood, they're offering anyone to get into that IPO price. So what is ripe for disruption is that private equity investing. I know you have to have $1 million minimum or make a lot of money per year, but who's to say Robinhood can't work around that and offer people, retail investors, a way to invest in private equity? And even if maybe those regulations or those restrictions are eased in the future, Robinhood would definitely be the first company or one of the first to just sneak right into that market. And this is a little bit more controversial, but I don't know about how regulators will like this at this point. So it could be something very long into the future, which is data licensing. And Twitter is something like this too, where not too many people talk about this when it comes to Twitter actually, but they have two sources of revenue: advertising and data licensing. Data licensing is like less than 10% of the revenue. I'm not sure exactly what percent, but it's a small portion. Twitter has this product where they can make it easy for companies to go into the tweets and get data from it or knowledge from it. And who's to say Robinhood? They mentioned in their S1 they have data, they have AI, they have machine learning. What's to say they don't get into some sort of data licensing program or product? So that's why I'm bullish. And I think so. They have 18 million accounts. They're going to grow that by internationally expanding into Europe and Asia. And all those accounts are going to get richer or more wealthier as time goes on. And that's really going to boost the net interest revenue. It's also going to increase the transaction-based revenue. It's going to increase the gold subscription revenue, which they can also improve upon. I don't think Charles Schwab has any subscription-based revenue right now. They're going to steal money from Vanguard and Charles Schwab. I think that's a big thing. That's not going to happen immediately, but after minimum 10 years, you're going to start to see that, I think. Especially 20 years, you're going to see that. And I think you're going to have a flippening. Kind of like what happened with Tesla and ExxonMobil. You saw Exxon going down, and Tesla going up, and then it flipped in the market cap, sapping that demand. That demand that would have gone to oil is gone to EVs. And I think you're going to see that money that would have gone to Charles Schwab, money that is in Charles Schwab is now going into money that's in Robinhood. And I think you're going to see that flippening. Charles Schwab, Robinhood, bam, flippening. I mean, how can you not be bullish? Charles Schwab has been around for a long time, and they only have 32 million accounts. Robinhood has been around since 2013. Maybe like fully opened maybe actually launched their app in 2014 and 15. And they have 18 million, more than half of what Charles Schwab has. That's insane. And the reason why I think Charles Schwab's done such a good job right now is because their founder, I think it's their founder, he's still alive. He's really old, but he's alive and he's working hard. He's working his butt off. I was reading a report recently or a while ago that he's killing it. He's working hard and he's making sure the company he founded is still on top. And I think, unfortunately, once he passes away, I don't know when it could be, I think Charles Schwab's going to lose that motivation. While the co-founders, Robinhood, are young, 34, 36, they're going to want that flippening. They see it. They want it. It's going to happen.